Hi, Old Lending Lady here to talk to you about interest rate buydowns. There are two types of financing techniques that sound the same but are very different from each other. The first is a permanent buydown, and the second is a temporary buydown. Just like the names imply, the permanent buydown means that a borrower pays the lender discount points for a lower interest rate for the life of the loan. Typically, it costs about 0.5% of the loan amount to buy the rate down by 1/8%. So let's say if you have a $400,000 mortgage, that 8% lower interest rate will cost $2,000. This discount can be paid by the seller or by the borrower, depending upon how the offer is negotiated. To negotiate the 8% lower interest rate by paying discount points, whether paid by the borrower or paid by the seller, may not make sense if the borrower does not intend to keep the property for more than 3 years. Historically, borrowers have negotiated a higher purchase price in exchange for a seller credit for closing costs, and that might not be in the best interest for the borrower. However, asking for a seller credit rather than a large reduction in purchase price to pay for the rate reduction could save thousands in interest over the life of the loan. The second type, a temporary buydown, is where the borrower's funds or seller credit is used to pre-collect interest to enjoy a lower payment for a period of time. You will hear the terms 1-1, 2-1, and 3-2-1 buydowns. The 1-1 buydown reduces the rate 1% for 1 year. The 2-1 buydown reduces the rate for 1 year, and then to a 1% lower for the second year. The 3-2-1 buydown reduces the payment to 3% lower for the first year, then 2% lower for 1 year, and then 1% lower for the third year. All buydowns reset to the locked rate after the temporary period has expired. Let's say that the rate was 6% on the day that you locked for a 3-2-1 buydown. That means for 1 year, the payment would be based on a 3% interest rate, then a 4% rate in year 2, and a 5% rate in year 3, then 6% for the life of the loan. There is no interest savings basically on the temporary buydown like the permanent buydown, but with a lower payment, the borrower can grow into the payment over time. Again, the buydown can be paid either by the borrower or the seller in a form of a credit at closing, depending upon the loan program that the borrower qualifies for. When using the temporary buydown, the money is held in escrow account to pay the lender the full interest due each month, and if the borrower refinances before the end of the buydown period, then any unused interest is refunded to the borrower. Please don't let higher interest rates keep you from buying the home you love. Speak with a mortgage professional about these financing techniques.